Today, we are strapping in for a high-speed, action-packed journey through one of the most revered and practically applicable trading manuals ever written. We are unpacking the legendary book Street Smarts by the absolute market wizards Linda Bradford Raschke and Laurence Connors. If our previous deep dives into market theory left you wanting actionable short-term trading strategies that you can apply immediately, you are going to want to take detailed notes today. Grab your favorite beverage, get locked in, and let us explore the fast-paced world of high-probability swing trading. This is not a book about buying a stock and holding it for 30 years while you wait for retirement. This is a battle manual for the modern swing trader and day trader. Linda Raschke and Larry Connors wrote this masterpiece to bridge the gap between abstract market theory and the brutal, day-to-day reality of extracting consistent profits from the financial markets. They focus on exploiting brief, recurring windows of opportunity that happen on a daily and weekly basis. By the time this video is over, you will have a comprehensive understanding of the exact setups, triggers, and psychological frameworks that elite short-term traders use to outmaneuver the rest of the market. Let us dive right into the core philosophies and the most powerful strategies this book has to offer. The philosophy of the short-term swing trader. Before we can start drawing lines on a chart or looking for specific explosive patterns, we have to fundamentally rewire how we think about the market. The core philosophy of Street Smarts is built on the reality that financial markets are incredibly noisy, chaotic, and heavily influenced by short-term emotional extremes. Raschke and Connors believe that predicting where the market will be a year from now is a foolish game for most retail traders. Instead, they argue that your edge lies in anticipating what the market will do over the next 2 to 5 days. As a short-term trader, your absolute best friend is market momentum, and your worst enemy is prolonged exposure. The longer you hold a position, the more exposed you are to random overnight news events, sudden geopolitical shocks, and unpredictable institutional block trades. Therefore, the strategies we are about to discuss are strictly designed to get you into a trade right as momentum is accelerating and get you out with a profit before the market has a chance to reverse and chop you to pieces. The authors also heavily emphasize the concept of fading the public. Fading simply means taking the opposite side of a popular trade. When the amateur retail crowd is aggressively buying a breakout at the absolute top, the street-smart professional trader is calmly looking for an excuse to sell short and ride the inevitable correction downward. Professional trading is about waiting for the rubber band of market pricing to stretch so far in one direction that it physically has to snap back. We are looking for those exact snapping points. Serving up a cold bowl of turtle soup, perhaps the most famous and highly utilized strategy in this entire book is a brilliant counter-trend setup playfully named turtle soup. To understand why this is so powerful, you have to know a little bit of trading history. Back in the day, a legendary trader named Richard Dennis taught a group of complete beginners, famously known as the Turtles, to trade using a very specific trend-following system. Their main trigger was buying an asset the very second it broke out to a new 20-day high, or selling short the moment it broke down to a new 20-day low. Because the Turtle system became so incredibly famous, thousands of amateur traders started copying it. They would all place their buy orders just above the 20-day high. Raschke and Connors realized that this created a massive, highly predictable pool of liquidity, and more often than not, these obvious breakouts were actually false alarms. Thus, the turtle soup strategy was born to actively hunt and trap those breakout traders. Here is exactly how the setup works in a storytelling visual. Imagine a stock has been trending downward, and it finally hits a brand new 20-day low. The crowd panics, and the breakout traders aggressively sell short, expecting the price to collapse even further. However, instead of collapsing, the price dips slightly below that 20-day low and then immediately reverses, climbing back up. The turtle soup buy trigger happens when the price crosses back above the previous 20-day low. You are essentially buying the false breakdown. The beauty of this strategy is its incredibly tight risk management. The moment you enter the buy order, you place your protective stop loss exactly one tick below the brand new absolute lowest price that was just made that day. Your risk is absolutely microscopic, but your potential reward is massive because you are catching a major market reversal at the very second it is being born. You are literally profiting off the trapped breakout traders who are now forced to furiously buy back their losing positions. Finding the holy grail of pullback trading. While turtle soup is all about fading false breakouts, Raschke and Connors absolutely love a strong, undeniable trend. When a market is legitimately exploding higher, you do not want to stand in its way. However, you also do not want to blindly buy at the absolute peak out of pure fear of missing out. You need a mathematically sound way to enter an established trend on a temporary pullback. The authors literally call their favorite trend continuation strategy the Holy Grail. The engine that drives the Holy Grail strategy is a technical indicator called the Average Directional Index, commonly referred to as the ADX. The ADX does not tell you if the market is going up or down. It only measures the raw, underlying strength of the current trend. A low ADX means the market is dead and chopping sideways. A high ADX, specifically a reading firmly above 30, means a massive, runaway trend is currently in progress. When you find a chart with an ADX reading powerfully pushing above 30, you simply pull up a 20-period exponential moving average on your screen. In a strong uptrend, you patiently wait for the asset price to temporarily pull back and physically touch that 20-period moving average. The moment the price touches the moving average, you wait for the current trading bar to close. Your buy trigger is placed exactly one tick above the high of that specific pullback bar. If the trend is truly strong, the moving average will act like a trampoline. The price will hit it, trigger your entry, and aggressively bounce back into the direction of the main trend. Your protective stop loss simply goes underneath the recent swing low of the pullback. This strategy is incredibly highly regarded because it forces you to completely ignore the messy sideways markets and only deploy your hard-earned capital when a massive, high-probability trend is actively dominating the chart. Catching the turn with the anti-setup. Sometimes, waiting for a deep pullback to a moving average means you miss out on the initial, explosive turn of a new trend. For these specific scenarios, the authors developed a slightly more complex, yet incredibly effective oscillator-based strategy known as the anti. The anti is specifically designed to get you into a trade right as a minor countertrend correction is ending, and the primary trend is aggressively resuming. To visualize this, imagine a stock that has been trending strongly upward, but it suddenly experiences a very sharp, violent 3-day drop. The amateur crowd thinks the sky is falling, and the massive uptrend is completely over. However, the street-smart trader looks at a slow stochastic oscillator on their screen. They notice that the longer-term trend of the oscillator is still pointing firmly upward, but the faster, short-term line of the oscillator has temporarily hooked downward due to the recent 3-day drop. The exact setup occurs when that fast stochastic line stops falling and sharply hooks back up in the direction of the longer-term trend. This subtle, visual hook on the oscillator is your green light. It mathematically confirms that the brief, violent selling pressure has completely evaporated and the original, aggressive buyers are stepping right back onto the battlefield. You enter the trade the very next day, riding the renewed momentum. The anti requires a bit more technical practice to spot with the naked eye, but it provides exceptionally low-risk entry points right at the exact moment a market correction is dying out. Exploiting the morning reversal with 80/20ths. Let us shift our focus to a strategy that is tailor-made for aggressive day traders and very short-term swing traders who love playing the morning open. The authors dedicated a significant portion of their research to observing historical daily price ranges, heavily inspired by the classic Taylor trading technique. They discovered a fascinating, highly repetitive behavioral quirk in the markets regarding how assets close the day and how they open the very next morning. They named this exploitation strategy the 80/20th setup. Here is the psychological setup for an 80/20th sell trade. Imagine a stock has a massive, explosive green day. It opens at the absolute bottom of its daily range and closes all the way up in the top 20% of its daily range. The financial news is cheering, the retail crowd is incredibly euphoric, and everyone expects the stock to go to the moon the next day. The very next morning, the stock actually opens slightly higher, pushing past yesterday's high, dragging even more late, greedy buyers into the market. However, the professional money knows this asset is completely overextended. Suddenly, the buying pressure completely dries up, and the price starts falling. The 80/20th sell trigger hits the exact second the price drops back below yesterday's high. You are immediately shorting the stock, betting that the early morning breakout was a complete fakeout driven by amateur euphoria. The inverse is true for an 80/20ths buy setup. A stock gets brutally crushed, closing in the bottom 20% of its daily range. The next morning it dips slightly lower, shaking out the absolute last remaining weak hands, and then violently reverses back above yesterday's low. You buy that upward cross. This strategy thrives on the undeniable fact that extreme daily closes are very often followed by immediate morning reversals as institutional profit-taking occurs. Bouncing back with momentum pinball. One of the most uniquely named and mechanically fascinating strategies in street smarts is called momentum pinball. This setup is specifically designed for a highly focused 1 to 2 day holding period. It completely ignores long-term fundamentals and focuses purely on an esoteric measure of short-term overbought and oversold conditions. The indicator used here is a customized variation of the relative strength index, applied to a 1-period rate of change. I know that sounds like a mouthful of complicated math, but the practical application is beautifully simple. The pinball indicator essentially measures the immediate, day-to-day elasticity of the market. When the indicator pushes extremely high on day 1, it screams that the market has stretched way too far to the upside and is highly vulnerable to a downward snap on day 2. When the indicator pushes extremely low, the market is severely compressed and ready to bounce upward. Here is how you trade it. If the Pinball indicator closes completely oversold on a Monday, you are strictly looking to buy the market on Tuesday. But you do not just blindly buy the Tuesday morning open. You wait for the market to establish its initial Tuesday morning trading range. Then, you place a buy-stop order safely above the high of the first hour of trading. If the market naturally pushes up through that high, your order is triggered, and you are officially in the trade, riding the upward elastic snap. You typically hold this position overnight and exit on Wednesday morning, taking a very quick, very clean slice of profit out of the middle of the market. The unforgiving reality of risk management. Now, I need to pause the exciting strategy talk and get very serious for a moment, because this is the section where most aspiring traders completely fail. Linda Raschke and Larry Connors are absolutely ruthless when it comes to the topic of risk management. They make it abundantly clear that you can memorize every single brilliant pattern in this book, but if you do not rigidly manage your capital, the market will eventually locate your weakness and destroy your trading account. Short-term trading is inherently chaotic. You will experience losing streaks. You will endure false breakouts that trigger your entry and immediately reverse to hit your stop loss. The absolute golden rule of street smarts is that you must never, ever move your protective stop loss further away once you are in a trade. A stop loss is an essential business expense. It is a protective shield that prevents a tiny paper cut from turning into a fatal, account-ending wound. The authors also heavily advocate for aggressively taking partial profits. When a trade explodes in your favor, do not sit there paralyzed by greed, hoping it goes up forever. Sell a portion of your position immediately, lock in that hard-earned cash, and then smoothly move your stop loss up to your break-even entry point on the remaining shares. By doing this, you mathematically guarantee a winning trade and completely remove all psychological stress from the equation. Professional trading is strictly about base hits, capital preservation, and emotional control, not swinging wildly for the home run on every single pitch. Final thoughts for the modern trader. As we wrap up this intense deep dive into street smarts, I want you to step back and look at the beautiful, cohesive tapestry that Raschke and Connors have woven together. They have provided you with a completely balanced, comprehensive trading arsenal. You have turtle soup for fading the false breakouts of the amateur crowd. You have the holy grail and the anti for aggressively joining massive established trends at the exact right moment. And you have the 80/20ths and pinball setups for surgical, intraday strikes based purely on emotional market extremes. This book is universally considered a modern classic because it firmly rejects the idea that trading is about mystical prediction. Instead, it proves that profitable trading is entirely about pattern recognition, mechanical execution, and unwavering emotional discipline. The setups discussed today happen every single week across stocks, futures, and currency markets. The exact patterns are always there, waiting for the trained eye to spot them. Your homework, right after this video ends, is to pull up your favorite charting software and start actively hunting for these specific setups in historical price data. Train your eyes to see the turtle soup fakeouts. Find those massive trends, and watch how price beautifully reacts to the 20-period moving average in a holy grail scenario. Thank you so much for joining me on this massive educational journey today. If you found immense value in this breakdown, please aggressively hit that like button, subscribe to the channel for more high-level trading education, and let me know in the comments below which specific strategy you are going to test out first. Until next time, keep your stop